Welcome everybody to the webinar here today. We're going to get started in just about 13 minutes. Hi, Meg. Welcome. There you go. Thank you for joining us here today. We're going to start in just about 11 minutes here.
Okay, great. Yeah, thanks for asking me. This will be interesting.
Yeah, no problem. At the very beginning, I'll pull up some slides and then I'll take those slides off when I'm just interviewing you and asking some questions, and I'll bring those back up when we're done. But I think we're going to have some questions from the participants as well, I'm sure.
No problem. Okay. Getting used to this type of thing slowly.
Sure. Yeah, no problem. All right, welcome everybody who's signed in. We're going to get started in just about 7 minutes here. I'm sure I'll have several hundred more people joining us. Just so you know, Meg, we had one of the emails that went out said 3 p.m. It's obviously 1 p.m. Eastern time when we're doing this. So the way the webinar is set up, those that come in at 3 p.m., we're going to see the webinar and it'll play as if it's being seen live essentially at 3 p.m. So we might have another 100 people that come in and see it at that point.
Great. Well, I know when I'm on film.
Yes, I mean, we have the film going now, but there's just about 100, just under 100 people that are signed in now, but I think we'll have probably 500 to 800 more people signing in over the next 10 minutes. So we'll cut the recording for when the webinar officially starts, you know, for the recorded version, but you know, people are watching now live, seeing the PowerPoint and a little mini version of our faces here.
Oh, I see. Okay.
Yeah.
But you'll keep track of the sound.
Yes. Yeah.
Not that yeah.
Yeah, and maybe I can put you on mute for right now, and then I'll just click unmute when we come to the interview part, and then that way you don't have to worry about it.
Okay, thanks. Yeah, I don't plan on anything, just.
Okay. Welcome everybody to the webinar today. We're going to get started in just 3 minutes. Got a question here from John. Yeah, it looks like you're connected. I'm sure if you can hear us, let everyone know via chat. We're going to get started in just about 1 minute. All right, welcome everybody to the Joint Venture and Co-GP Strategies webinar. My name is Richard C. Wilson from the Family Office Club, and we're covering this topic because there's been a lot of business getting done between Family Office Club members who are sponsors, investment firms, or that run investment funds, as well as between family offices and independent sponsors. And business is getting done through joint venture and co-GP strategies every day. And I think this topic is really not addressed enough by us. And I think a lot of people don't know how to approach their first joint venture deal. So I wanted to provide this webinar. It's just an introduction to the topic. We have a guest that's going to be joining us just a few minutes. We're going to be interviewing her. As you probably saw in the invite for this webinar, she's going to provide some case studies of real negotiated deals that she's been through. And then I'm going to go through a couple other case studies from within the Family Office Club that are happening in real time. We're going to cover a few insights or mistakes to avoid, and then we're going to take questions. We're going to take questions at 2 different times. First of all, you can submit your question anytime, but really after the interview with our guest, we'll be taking a few questions directly for her, and then we'll be taking a few questions at the end. We'll really try to get this done in 1 hour for the total content. I know I've been going over on some of them because we don't want to shut it down and just ignore 40 questions we have from people that were on the line and bothered to submit the question. We're going to try to cap this one at 1 hour for today. So I hope you will enjoy the content here. I want to go into, first of all, a little bit on the Family Office Club. If this is your first experience with us, we have met with well over 2,500 family offices in person. I started the organization in 2007. We've had over 1,000 ultra wealthy investors and family offices and private investors speak on stage at our 140 live events. And we've also done 35 of these recorded webinars. We've done many virtual discussion panels, which we do every week now. We also every day record and upload an investor mandate interview, which is a 7-minute interview with an investor on exactly what they're looking to invest in. A few of the 65 investor mandates we've recorded now are exactly on co-GP investing. And then we also have done about 7 or 8 member spotlights of active members within the Family Office Club to share what they're doing with others. One of those was with our guest, Meg Epstein, so maybe some of you have seen that. If you're not familiar with our offering, essentially we offer 130 plus proven capital raising strategies to our members, as well as access to the virtual investor discussion panels. Those are not public, as well as access to the recorded versions of all of our 30 plus webinars. Otherwise, you're only getting half of the recorded webinar, or some of them are not public at all. We also give quarterly pitch deck coaching and deal analysis, access to investor leads, and basically access to those investor mandates, which are recorded daily. The public versions of those don't have their last name, their firm name, or contact details. The version within the membership, when you log in, has all that information. On the homepage of familyoffices.com, you can see the types of mandates we have within the portal. So I'm not going to read that over to you here now, just for time's sake. But during this webinar or at the end of it, if you want to join the membership, just go to familyoffices.com and fill out the form at the bottom of the homepage. If you love podcasts, we've got one called the Family Office Podcast. We have maybe 160 to 170 episodes on there now, and we're uploading 2 episodes every business day as our typical pulse. So that is growing quickly. We also have been at this for 13 years. So when we're providing the insights within the portal or within the webinar, it's really coming from what we see working in the industry, what's going well, who's getting momentum, what the smartest family offices are doing, what everyone's doing who's raising 10, 20 million or more in capital every year. That's what we're really trying to shine a light on, so that everybody can make more efficient use of their time and be more effective, whether they're an investor or someone who is raising capital. Okay, so why talk about joint ventures in co-GP strategies? First reason is speed. It could be speed to getting to 100 million in assets, speed to getting to some level of credibility that you believe things will get easier at, speed at executing when maybe it's the right timing with a distressed investment opportunity, or maybe in a certain area there's not enough inventory of a certain type of real estate. And if you're able to build and get that in place before others, they'll have an advantage. It could be focus. You might find that you're really great at development or securing or negotiating operating businesses for acquisition, or at aligning financing, or at running a company after it's been acquired. And you don't want to deal with the capital raising or the structuring. Well, that you could joint venture or co-GP with a few others to get more deals done by focusing on what you're best at. So that's one big advantage of a joint venture. A potential ROI, if you're focusing on only what you're best at and you're able to move faster, obviously the end result we're all looking for is a better result in terms of how much time we invest and money we invest and what we get in return. A lot of that comes down to momentum. What I mean by this is that if outsiders and your own team and your business partners just feel like you're not getting anywhere, you're going to lose their trust as a leader. So many times if you're not getting momentum, just opening your brain to the options is going to be something that's going to be beneficial by listening here today. Getting access to more deal flow, access to more investors, access to whatever your bottleneck is, and finding that joint venture partner that has all the access you can need in that area is another reason to consider joint ventures or a co-GP structure. And just to make sure everyone's clear before I jump into this, you might be buying one operating business, you might be buying a portfolio of real estate, you might be trying to raise capital for something small or very large. It doesn't matter which term you use essentially, but when you set up a joint venture, it's really trying to find parties that are complementary to your core skill sets. And co-GP is simply just saying that in the traditional investment structure of a GP finding the deal, structuring it, and running the deal, and bringing in limited partners to come into their general partnership offering essentially, then the limited partners have limited risk. They're not operating the asset. The general partner has more risk. They're putting some of their capital on the line at risk. And a co-GP deal is just saying that at the management of the deal level, you bring in 1 to 2 other parties to kind of joint venture on the project in a limited way, a very limited way, or a very broad and open way. Sometimes it's a 50-50 right down the middle partnership. Many times it has to be customized to what they're contributing and what's needed on that deal to be successful. I just want to make sure that is clear and kind of out of the way before we jump into too much of the content here. Okay, so the main point of today I think will be interesting. Instead of just having me talk about and rattle off 20 different case studies, I kind of wanted to do a bit of an interview and a little bit more of a deep dive with one of our family office club members. So I brought here on the line Meg Epstein. Meg, if you'd like to say hello for a second here.
Hi, everyone.
Great. And Meg is from CA South, which is a real estate development firm. And I'll let her describe it in the most accurate way possible here in 1 second. But we've gotten to know her through our live events and just being part of the community over time. It's impressive she's been able to build the operation that she has in such a short amount of time. And unlike a lot of people who go to high net worth investors and then jump up to going to the ultra wealthy, she kind of went straight to the ultra wealthy, but also used joint venture and co-GP deals to get there. And since she's gotten more momentum than probably 90% plus of members in the family office club within just the first 3 to 5 years of their business, I thought she'd be a great person to have here to interview. So Meg, why don't we have you just give a little bit of background on CA South, maybe what's been key to your success, and a little bit about your value add process so people understand the type of business you're really in.
Sure. I say that we're a vertically integrated real estate development company and investment management. So we have a private equity fund as well as use various partners. So we'll go into the exact structure with co-GPs or LPs, but it's definitely been part of how we've been so scalable. We focus on niche asset classes, kind of boutique size deals in Nashville. We have over 225 million of projects underway at this time, and we've been at this for about 5 years in Nashville. And I originally came from California, kind of brought a perspective to the Southeast from the coast. And I really appreciate Richard having me on. When I hadn't raised any money, I went to one of Richard's conferences in 2016, I think it was, in New York. So I've taken a lot of the principles and applied them.
Great. Great. And I guess you're not focused on one niche asset class, but you are focused, at least for now, on deals in one location on Nashville and the surrounding area. Can you talk about that just a little bit on that approach and whether you think it's helped you or hurt you, or how investors respond to not being niche in an asset class, but niche to a location?
Sure. I think on the co-GP basis, it's really helped to know the market like the back of your hand, especially in a smaller market like Nashville. It's a very small real estate community, and most of the deals I get come off market. And so it's helped that I've focused on that market. It's also been sort of the darling of, investment in the last year or two. So it has been relatively easy to raise money in Nashville. A lot of, bigger investors in New York or Chicago, these type of places are interested in placing money in Nashville. People love coming to visit Nashville and any excuse to come see it. And so that's definitely been an advantage. I think it helps to know the market very well. On the fund side, I think a more institutional investor could see it as, it can be perceived as unfocused. And in my case, I've leveraged, my board and consultants and professionals and my co-GPs to really fully, get to know the asset class and be able to perform well in it.
Okay. And out of all the deals you've done, can you talk about what is that total number of deals and how many of those used a joint venture or a co-GP, approach?
Sure. So we're at 12 deals now, 3 of which are still in the, we haven't broken ground on yet, but in the preliminary stages. Of those 12, 4 were done as with either my private equity fund as the LP or the Opportunity Zone projects. We tend to do more with LPs. So 5 of those deals have been with co-GP structure.
Okay. Great. And then can you give us an example or two, maybe 2 case studies of joint venture or co-GP deals that you put together where maybe somebody helped you in either sourcing the deal or sourcing some of the investor capital or some sort of a partnership going into it that otherwise you might not have gotten that deal completed?
Sure. I'll give you the very first co-GP I did and the very last one.
Sure.
It's a good range. The first project was 77 unit residential mixed use building very close to downtown Nashville. The first thing I did was get control of the deal, and it was a very solid deal in terms of returns. And my track record wasn't as developed in Nashville at that point. And so what I first did is I got control of the deal and put together a package. And then I started interviewing co-GP partners, and, I went to various, networks and the partner that I ended up doing my first deal with, I found through CCIM, which is a certified commercial investment member,
Right.
Which has been a great program that I've gone through. And they were based in Michigan, but they were looking to deploy, get into the Nashville market again, exciting market for a lot of people. And so they saw the deal and came and toured the project. And we basically, once they decided they wanted to do it, which was, very short turnaround, thankfully, because I think the merits of the deal were strong enough. They interviewed me, they interviewed my development partners, my architect and builder. And then we'll set it up in a pretty typical co-GP structure where we split the development fees. The principal of the fund signed on the debt when he had a much bigger balance sheet than me at the time. And then basically it was my first co-GP deal, so I didn't realize it was interesting, but he had put a very high preferred return on it because it was our very first deal together. And instead of having a typical waterfall split, he did a high return, and then I got 100% of the promote after the pref. And
Right.
and he did that to de-risk his own return. And that deal ended up being a 78% IRR. So I ended up making about twice the amount that he did, even though he put in all the money and
Right.
on all the debt. But that's just the way it goes sometimes, right? And he had a more guaranteed return, and I took more risk. But it ended up being, he didn't know that at the time. We still joke about it. But I think in that case, that one went so well. I think we're on our 5th project with that one partner now. We have about 125 million together. So I can get into, the lessons I learned from that later, but that was pretty much a good template for us. And we kind of have continued to do it from that same, yeah.
Sure. And what would be some insights we could share, I guess, on that one? I think getting your first deal done has to be by far the hardest or most intimidating for those who are listening and trying to get that done. What would you say to guide people so they don't waste as much time? Obviously you are open to different types of terms because that's an unusual arrangement, but it turned out in your favor, even though it might have seemed like somewhat vulture-like or very protective from the investor's point of view. The deal went so well, it actually went better for you than it did for them, but it went great for both of you, obviously, and they came back and invested with you again. But related to terms negotiation and just getting someone to take you seriously when you're in your first deal, do you have any suggestions on helping people get traction there?
Sure. I think the merits of the deal have to be, I would put your best deal forward and really test it, and you can get professional opinions from your mentors, or but really do your own due diligence and make sure the deal can stand on its own, and put your best deal, because that's how you're going to start a relationship that gets repeated, especially in this climate. People want good deals. The second thing I think that is important is you want to choose partners with complementary skill sets, not someone with a similar skill set. So obviously I hadn't raised, $9 million before, and he had, and really, technically dependent, usually the person providing the capital in a co-GP wants control. And, if you're the boots on the ground, you don't necessarily want someone that's going to be helping you, choose the finishes or something like that, or wants to be involved, in the day-to-day. And so it's helped, because in that case, that my partner was pretty removed, and he has the power to take control if he needs to, but he just never really has. And it's kind of it feels more like an LP relationship. So I would say, you want to choose partners that have complementary skill sets to yours and not the same, where, that could lead to, where you're kind of easily divisible, dividing tasks.
Right. And since that deal was a $9 million capital need, having done smaller and larger deals since then, I would assume, do you have any comments on the size of the deal? Some people say bigger deals are easier to get done and you make more money. Others, say, well, get momentum, do a small $1, $2, $5, $9 million deal before you try to do some $50 or $100 million deal. Do you have any feedback if anyone here is swinging really big on their first deal, or any feedback on what's too small or too big to be worth it or to be credible on your first deal?
Yeah. I always tell people that I'm giving away my secret and just thinking big enough, but I think it's just people can't conceptualize doing a $30 million deal to start, but it really is easier, and you can say to people that, you can tell people that over and over, and they just can't think with really doing it. So I don't worry about anyone competing in my market or something, but it's just, It really is easier, much easier about 10 million to find investors. Now, are they going to give someone $10 million that has no track record? No, but I also leveraged relationships on the sponsor side. My architect builder, he was a development partner essentially, and he had done this for a couple decades before. I brought in another local developer in Nashville that had been integral in developing Nashville over 40 years, and he was involved in the sponsor side as well, just to have some gray hair. So you have to give away maybe more of your deal, but you need to bring in, you can essentially offer people equity to get an A team together that has the track record. And that's what this is all about. What we're talking about is co-GP and finding partners and, you know, scaling up quicker because you can leverage other people's assets.
Right, right. Great. What about a second case study? You said you had one that was more recent?
Sure. So the lesson I learned there was to launch the mixed use platform. That was the way I did it, and it worked really well, obviously, for me. So I did the same thing in Nashville. I originally focused on a product type in a boutique size investment, and the same thing led me into industrial, which was looking at the data, looking where the niche asset classes that were not being served by bigger developers, and I saw the need in the market. But I, you know, and it was below 3% vacancy. It was a no-brainer. So I wanted to do the same thing that I did with the other strategy, and I found a good deal. I started calling the brokers in the space and getting to know the industrial market. I found a great deal. Same thing, interviewed co-GPs, went on LinkedIn, various networks, looked for the best institutional level industrial developers. And I found one that was really interested, again, to break into the Nashville market. And, you know, maybe it would help other people that aren't in such a market that's so trendy at the moment, like Nashville, but maybe it would help people to interview people more locally or something. But the point is you have to get control of the deal, because then, you know, someone is interested in partnering with you.
Right.
And so in that case, so this was an industrial, which is quite different than mixed use. And so I, chose a partner that's been doing this for 40 years very successfully. And we did the same thing, delineated responsibility. In industrial, there's a lot more of a due diligence process. It takes a lot, it's much more expensive and extensive to figure out land zoning and those type of things. So we pretty much decided, I'd be the boots on the ground. I had the deal. They would provide the debt and equity. And in this one, again, we split the developer fee, and the GP side of the equity contribution is also split, and they provide, the LP capital at 7% with the LP in this one, and we split the promote above the LP.
Right, okay. What about locking up, especially on the first property? What do you do to lock these up? You simply put them under LOI, and then you have a clock on your back for finding that co-GP partner, and maybe you kind of soft circle the teaser version before you hard lock it up? Or what does that look like? Because we have a question about that in the chat stream I saw.
Yeah, to be honest, when I first did it, I was a bit more off the cuff, and I just brought I'd shown the idea to the investor, and I trusted him enough. And, technically, I guess he could have gone around me, but he didn't. But I would recommend, definitely, if you can, it's been, especially in this current climate, maybe it's not so much of a seller's market where people, I don't know about I know about other places, but in Nashville, sellers want you to close on a $10 million parcel in 90 days now. And maybe that's loosened up more recently, I hope. But if you can get 120 days of due diligence, or at least, especially on a ground up deal, or, on in real estate, try to get enough due diligence of a runway, but also do your own research now. If you know what kind of asset class you're going to focus in, if it's in apartments, then see who's really active in that area, in the type of projects you want to be in, and do a lot of research before. So that way, when you have your deal, you know who to go to. And if it's a good deal, it shouldn't take more than a month or two to get some, fairly down the line, if it's going to get funded.
Okay. And are the GP partners of yours requiring you to put up 5 to 10% of the capital, and then they'll bring in the rest of that capital, or are they not requiring you to put up any capital?
No, we usually put in capital, okay. But it's not as much as people would think. It's a negotiable point. Sometimes we just cap it at a smaller percentage, but as I've grown, it has, it's become less of a problem to put in 50% of the GP position or something. But in the beginning, you know, if people, if you get to know you spend enough time with the investor or your co-GP and they get to know you and they trust you, then you'd be surprised at how flexible people will be.
Right, right. That's good to know. Okay. What about, we had a question here about IRR expectations. If it's an opportunity zone deal versus not, do you see a big difference between return expectations when it is qualified as an opportunity zone and it's structured to take advantage of that?
Yes, I don't underwrite any tax benefits into my IRRs, and I think people appreciate that. But I think that most people, especially in this environment, are still looking at high teens over a 10-year hold, which can be um, tough to accomplish. Now, I tend to be really conservative. I think I'm too conservative in my underwriting because my projects don't, where they're placed in Nashville are, a mile from Amazon, and I'm not accounting for huge appreciation that we've seen in the market.
Mm-hmm.
But I think high teens IRRs for ground up development is just what's expected even across a 10-year hold. I don't think people will get there at 12 or 14.
Right, right. And do you see during this virus kind of crisis, for those listening live and not, a year or two from now, do you see a big change in Nashville, not just in deals getting done? Obviously, I'm guessing less deals are getting closed every week there, but on pricing yet, do you see any changes? Are there any adjustments in either strategy or execution that you and your team have made since the beginning of March?
Sure. I haven't seen a big, we've had, I point to two projects that I was actually surprised to see close $250 million loan on a very large mixed use project a couple weeks ago. High-rise luxury hotel project went forward, as well as a land parcel for about 1.4 acres for $35 million for a hotel site. So those all went through. I was going, wow, these people really have some guts. But so I haven't seen a huge adjustment. I think everyone's sort of on pause, but Nashville's just innately a bit of an opportunistic or an optimistic place. And I think people think that by summer this will all be over. I don't know. I can't imagine that things will just go back to normal. But I haven't seen that as much. For me, I was already, we had unbelievably got hit with a tornado a couple weeks before the virus. And so
right.
I was already very bullish on my industrial strategy because I'd watched the market and launched that with my partner in the last year. And especially when the tornado came, I thought, well, we really need to increase, the supply is even less. So I think the industrial sector and multifamily are gonna be the preferred investment types coming out of this, or for the next couple quarters at least. And so I think that's going to be a big part of my focus, especially opportunity zone. I found there's one project on a co-GP basis that I've been working on funding, and I've gotten a commitment in the last just a few weeks of sending it out, and that's just because people in the long run think over 10 years Nashville's a good bet, so in multifamily. So
Right. Okay. Yeah. And I think Nashville is known for being a strong healthcare city as well. I know. And obviously some parts of healthcare right now are busier than ever for bad reasons. So can we move on to then, I guess, some top insights you've gotten, some best practices or lessons learned from structuring co-GP deals?
Sure. I think, well, in the industrial space, for example, I think even as I've gotten bigger and had success and, raised my own private equity fund, and I still go back, and it's actually, I think a co-GP relationship is very beneficial, and it's how I started, and I'm still, it's probably the most successful thing that I've done to leverage. You're sharing, especially on the industrial side, you're sharing all your due diligence costs, which can be in the hundreds of thousands for one deal. And so if you have a strong co-GP partner that will share those with you, then that's a huge benefit. Also, in my case, I've relied on my co-GP partners to bring a lot of the debt and equity. And that takes a lot of time, as a lot of people here have probably spent, what we're doing in the Family Office Club. I mean, it takes a lot of time to raise that. So if you can divide your time and be the person on the ground bringing the deal, or you're going to be the operator, then it's just, I mean, it's all about the scalability factor. And I think people, it's like you have to really look and go, okay, do I want to be the sole owner of one $10 million deal, or do I want to own 30 or 40% of $100 million in deals? And I think people, have to, you should, it's worth looking at, even though it can be some heartburn to give away so much equity sometimes for
Sure.
people. And then the other thing is, it's just instant credibility. I was not an institutional level industrial developer, for example, but working with, a great partner, we've been able to gain that credibility. And then you also learn a lot from, people that have had decades of experience doing it. And so those are the benefits. I think the main things that I would recommend is really just being clear about the roles and delineating that in the beginning. Fortunately, I haven't had a problem with that, but a lot of people have. And, down to who's going to be responsible for investor reporting, or, just really, really dive into the details with that, as well as fee structure and, your developer fee. I mean, it's never been a problem for me, but developer fees can get paid in very different ways. It can be based on the amount of time or the amount of work done. And so, if you're really depending on those, you have to work out with your partner what's fair. And then otherwise, it's just like anything, which is an experience in any business, is it's all about who you're doing business with, and doing your own due diligence and building trust, and the basic I think the lessons that anyone learns in business and having partners, right?
Right. Okay. We have 2 questions from John and Richard here. And if anyone else wants to submit questions through the Q&A panel, it'll be easier to identify your questions if you can start submitting them there for Meg. John had a question about what is promote, and then Richard had a question about the first case study you gave. If you can share a little bit on the breakdown of how that high preferred return structure looked like. I thought maybe both could be kind of addressed within one answer, perhaps, with that example of just like what a promote is, and that example of what the numbers look like in that first deal, if you're able to share at some level of specificity.
Sure. So promote, just think of it, I suppose, as the back end of the deal, the back end profit after the person that puts in, and it's so second nature to me. I'm sorry, I didn't clarify that before, but the person who puts in the money, so say you need $1 million for a deal, will usually want a preferred return. That's how I've seen every deal structured, so that they get paid based on the time their money is deployed. A typical return would be, 8% on a mixed use project, for example. So that person's going to get $80,000 for every $1 million they invest every year. And then what's left over is the back end profit that you're going to split up in different ways. And typically the money will want at least half of the back end profit. So that just gets given to whoever provided most of the money. And then the rest of the profit is split between you and your partners in various ways. Most of my deals have been about a 50-50 split with my partners. I think I've also been luckier in some cases, and as the deals get bigger and more of an institutional quality, it's more like 20 or 30% of the back end is what you could expect. But then it's all relative. You're looking at $10 million in profit, so it's still worth it. Right,
makes sense. Juan has a question about your partners. I know you mentioned one was from Michigan. Out of the 5 or more co-GP deals you've done, how many of those were local versus out of the state or out of the region?
Everyone was out of the state.
Okay, great. Another question here. What was our main reason for the co-GP balance sheet to support the recourse? If so, Why does she still do it? When will she outgrow it? So I guess he's talking about the debt piece. The reason for having them co-sign on the debt. I would guess it would make the bank more comfortable having that established capital partner or principal with a larger balance sheet. Is that why you use them on the debt, or can you go into a little bit more detail on that?
Well, if you're doing a co-GP structure, then you want the person, like, why not share the risk with the person that is getting the fees alongside you? I mean, that's one of the main benefits of it.
Right.
I'm self-made. I'm in my mid 30s. I'm self-made. I'm doing $225 million worth of deals. It's not because my balance sheet's that big. So you have to leverage that, right? The other point is that, will I outgrow it? And so in the case of my first partner, we just have a great working relationship. It's not some big deterrent for me to co-GP, because we have a great working relationship. We're 5 deals in, we've never had a problem. And, it's really, in the end, it really is about who you work with, and, are you enjoying it? Are you liking what you're doing beyond just returns, right?
Right. Well, we have a question here about getting copies of the webinar. We will have copies of the slide. The recordings, we usually just provide half of the recording to non-members. The full version will be inside the portal for members. If anyone's listening to this first half and they had trouble getting on for the live part at the right time, we're happy to give you the full version of this one. But we've got 30 plus webinars in the portal that are recorded full versions. So yes, we'll have this one recorded as well. Hurdle rates, and many times people use a 7 to 8% preferred return in development because maybe the returns are a little bit higher than what a cash flowing kind of C-class multifamily property might be, for example. What type of hurdle rates are expected within your space? Is it that 7 to 8 or 6 to 8% preferred return still, or?
On the LP side or the GP?
In terms of the LP side.
6 to 8, I'd say. I mean, up to 12 depending on the deal, but maybe if it's your first deal, you could go to 12, but I don't really anymore.
Sure. We have a question here from Leonard. Why would your partner want to give you all the returns over a hurdle? I know part of the answer is because the hurdle was very, very high, but I don't know if you want to address that further just to make it clear.
Yeah, I mean, in that case, like I said, he never would have imagined that I would have made twice as much when he gave me all the money and he signed on the debt. But it was because he did this project, I was very conservative in my underwriting, and it was, I did not have as much of this was when I started in the very beginning, and it was his way of de-risking his own capital to where, no matter what, he would get a return. And that's what mattered to him more than needing to make, 40 or 50% return on his capital or something. He cared more about keeping it and making sure that, I was who I said I was, and I knew what I was doing in Nashville, and the market was going to bear out. So.
Sure. Okay. Did you have any closing fees at acquisition or exit on your deals? Do you have, acquisition fees?
I don't do acquisition fees. In some cases where I've acted as the broker on the buy side, I will keep a fee, but otherwise especially if you're on a co-GP, I feel like it's, I try to keep my fees very fair and be very transparent. I think I don't think investors appreciate it when you have an AC fee and then a project management fee and a development fee and a disposition fee and closing debts. I've seen everything. Right. I just want it to be one number that's very transparent. And that's something I think that's served very well, especially in working with co-GPs.
Awesome. Yeah, we're always trying to encourage people of that. I know there's different ways to be successful, and some people do have 19 types of fees, but we're always trying to emphasize that in our webinars. In terms of tying up the properties, we have a couple questions here about, did you have to put money down to tie it up exclusively? Did you have to show a proof of funds? And if you're early on, any other, details you could provide on locking up the opportunity?
Sure. You always have to come up, in my experience, especially if it's a, several $1 million parcel, you do have to come up with, at least $100,000. So if you don't have that yourself, you can get that from friends and family if they trust you, just like anyone else starting out. Or if you have gotten to know your GP, your co-GP, and you say, hey, I've been doing a ton of research, I'm going to be looking for deals, quite possibly they would split that with you if you didn't have control of the deal, or maybe if you have a repeat relationship. If they're brand new, it's much better to start with your best deal to get them enticed. A lot of people are busy and they have plenty of deals to do, and so unless it's very captivating, I don't know how much attention you would get.
Sure. And, you see little disclaimers on advertisements saying results are not typical. And I would say your success is not, typical of everyone who tries to go out and get their first few deals done. And we've got a question here from Leonard about your background, on your academic and business background. He's probably wondering if maybe you came into this with some enormous advantage or some edge, or maybe something that really helped you get so much momentum quickly, maybe.
Yeah, no, I mean, I didn't start with any family capital or any background in anything. I started on job sites when I graduated from college, and I'm a commercial general contractor. So that was how I came about it. It's not typical of, when you're managing a real estate fund or something. Usually people go to business school. I hire people that went to business school, and they tell me, and they give me their advice and things. But I really, I guess I was more on the scrappy side of things, but learned on the construction end, and got to know a lot of people that way. I spent my first couple years on job sites with 50 guys. And so, I learned how to lead, I guess, is all I can say. But I didn't start with any formal training. I went to UCLA. It's it's very academic curriculum, not vocational at all. So I really didn't learn anything. I applied beyond just people skills, I guess.
Right. Okay. We have a question here from RL. Do you have experience in raising capital using Regulation A? What are your thoughts?
No, not really.
Okay. Yeah, and I think that from what I've learned by getting to know you, Reg A is really for, if I'm not mistaken, kind of crowd A, very small check size. I'm not even sure if investors have to be accredited with Reg A, where, you've gone almost the opposite direction to co-GP, joint venture partners, or straight to ultra wealthy investors. So if there was a regulation for only going after the ultra wealthy, which, there are for accredited investor and qualified investor, but you've gone to a higher level than that for most of your energy invested, I think. And there's a question here about where do you advertise to get your investors? You mentioned earlier you've gone through a couple of networks to identify potential investors. I know you use the phone a lot to reach out. Any suggestions on getting responses and traction when maybe people out here on the webinar feel ignored when they reach out to people, perhaps?
Yeah, I wouldn't, it is tough because I know there's a lot of people that do really well at syndicating, and I've been the most successful, as Richard mentioned, at getting one partner and one check per deal. And I think that's definitely been part of my success, but I wouldn't say it's necessarily easier. And, especially in my private equity fund, I'm looking at taking smaller checks because the minimum investment made so far, excuse me, has been about 5 million. So I, it's tough for me because I haven't been successful at doing that, at taking smaller checks.
Sure. We have a little more sophisticated question here from James. How important is it for LP investors that you have a fiduciary liability? Or said another way, as a GP or co-GP, does your structure allow your co-GP entity to be an LLC to limit your personal liability? Or are you personally liable, on multiple levels, with the type of deals that you do?
Yeah, and the GP, you're personally, each project has its own LLC and there's certain protections in place, but I'm always signing on, even if it's non-recourse debt, bad boy carve outs and things like that. I'm always on the hook for most, yeah. Not financially to a certain point, but for legal reasons. I think my attorney is actually writing in on the panel right now.
Yeah. And Matthew has a question about who manages the construction and design of these projects after they're greenlit. From my understanding, that's one of your strengths is that you manage the construction and the design. To what degree is that true, or am I off on that?
Yeah, it actually just depends on the type of what platform we're talking about. So in the
Okay.
industrial, I can do it. It's not my day to day anymore because I couldn't raise capital and do all the other things if I was, going to job sites, but I do make it out there quite a bit. And I understand what's happening in certain platforms, like my mixed use platform. One of my development partners is an architect and builder, and that's, he has equity investment in the project as well. So he's very aligned with profitability and getting the project done on time and budget and schedule. And in that case, it's not a very active role for me. On the industrial side, I am more involved because I hire someone on CA South's team who has 30 or 40 years of experience, and then it knows what they're doing. But we have, like I mentioned, 12 projects going at any given time. And so it does take some oversight from me. And, I have a COO, general counsel that's watching everything.
Sure.
And we use software. We use great project management software that really, it's very easy these days to make sure everything is on schedule.
Sure.
Or not.
Okay. What about regarding scalability? If you could go back in time when you first started out, knowing what you know now, and do one activity or learn one skill that would have helped you scale bigger and faster, what would that be?
I think I wouldn't, I really feel comfortable with the amount that I think growing any faster than I did would have been a bit unhealthy, but
Sure.
I think I'm just sticking to bigger deal sizes and really having the discipline to remain focused in a project in what you're really good at. So for me, it's $10 million check sizes in Nashville of certain product types. And that's better than, and sometimes you get tempted to do smaller deals, for example, because they're so much easier and it's going to be so much simpler, but it really is actually more complicated because you have to end up syndicating or things like that. And it's just as much work. And so I think it's just about really getting really good at one thing or working, assembling your platform around one thing and building off that faster than than doing deals that are too different.
Yeah. Awesome. I don't know if you had listened to a couple of our webinars last month, but I've been kind of pounding that point home to people to, if they don't have momentum, niche it down, focus on one thing, get momentum, hit one type of investor between the eyes with value. And it seems like that's a big part of your success. Ryan had a question about, and it was going to be one of my final questions for today. We have a few more we'll try to get to within the Q&A section here, though, about top mistakes that you could avoid next time, or a mistake or two you could share here with people listening so that maybe they can avoid. I would guess one mistake you've kind of brought up twice now is going too small or staying too small would be a potential mistake, and making sure that you're going to large enough size deals where it's really worth your time would obviously be one point of advice on that. But any other mistakes you'd like to share?
Yeah, and I wouldn't say it's been as much of a problem on the investor side, but more on the GP sponsor side. When you partner with people, I mean, especially in a real estate development deal, and it's probably even much longer in a private equity deal or an opt-own deal, you're signing up with someone for 3, 4, 7 years. And so really not, I think delineating the roles on my very first deal, I thought I was mainly in charge of just providing the capital. And, I thought I thought the people I had partnered with would be doing a lot of the active investment. And the reality is when you're responsible for the capital, or you're the one raising the capital or bringing in the capital partner, if something's not getting done, like your retail space getting leased up, or the sales team getting all their deliverables so you can launch sales, these type of things, it's going to fall on you. And so, and as a developer, your fee, in the very beginning, I had to do a lot of the work and bring in, a full-time attorney, for example, to help me bring him on my team to help me do the workload. And, I wasn't getting paid the fees to do that at the time. And I had to, it's all in the back end. You're waiting for the back end. And so I think really just delineating exactly what the roles are and who's getting compensated for what really matters, because when I first started out, I actually didn't really want to be an operating developer. I was more interested in, placing the capital and high level. And the reality is when you place the capital, unless you're working with institutional level sponsors, you can, and my standards are pretty, I can be pretty demanding, I've heard. So maybe it's just me, but I want it done and I want it done the right way. And it's a lot of times that's going to be your team if you're responsible for it. So
Right.
that's been the biggest thing, I think, is just knowing, who your partners are and what exactly they're going to do, and have something in place. If they're not going to do it, have some, mechanism in the contracts in place to where you're not stuck with them if they're not doing their job, or, it can end amicably.
Right. Okay. And for a lot of your projects, are you ground up development, or are most of them kind of value add improvements?
Only ground up right now. In the Nashville market, it's so undersupplied in the asset classes that that's really the only opportunity. Value add apartments and certain strategies that are a lot more popular are just completely, the margins are just way too slim. My returns are closer to in the 20s to my investors. So to get that, you have to do ground up in Nashville. But, depending on how long this lasts, I would go into distressed assets or something like that eventually. But right now it's only ground up.
Sure. Daryl's got a question. What's your number one strategy to locate great locations or great opportunities?
I've always been a cold caller, so I get and it's not fun necessarily. It's depends on your market. In smaller markets or southeastern markets, the real estate community tends to be very small, so I always get properties off market. But you can be creative and not just call off tax records or something. If you really think there's a parcel, it's pretty obvious to look in the path of development. I always tend to look at the downtown urban core because urbanizations become inevitable, and look at around the downtown urban core where there's neighborhoods that are walkable. Those are the places in Nashville and that I've seen, as a trend across America. Where can people buy still affordably that isn't already completely gentrified, that is walkable and close to downtown, in between the suburbs and downtown, that has, those certain qualities where it's nice enough, takes a bit of common sense. But if you identify a parcel, hire a personal investigator and get the person's cell phone number, or be creative about how you can reach the seller. And, I go out to coffee with sellers of parcels 3 times a week, probably. Sometimes I feel like all I do is go out to coffee, and just sometimes it takes a year to get to know a seller and get him comfortable enough. But then in the end, because he knows me, maybe he'll contribute the land, or I can buy it from him, and then he's going to take the money and reinvest it in one of my opportunity zone deals or something more creative than just looking on the market and having brokers negotiate your deal.
Yeah, I think it's such a valuable thing you just said. We've had one time where we got hold of someone who owned an asset, and one time where we closed the deal on an asset where their phone number didn't work, their past business phone number didn't work, their email didn't work, the WHOIS information on their domain name wasn't accurate. And through one of them, we found their husband on LinkedIn, and then he connected me to the wife who owned the asset, and we bought the asset. The other one was an 83-year-old, and ironically, the only way we could get a hold of him was through Facebook Messenger. And then we responded and then got his cell phone that way. So I think that the rewards sometimes come to those that are willing to dig down at that level, like what you're talking about, to have coffee with people and be persistent. And if you're buying assets in 9 different cities across the Southeast and the Northeast of the US, how are you going to compete against Meg Epstein, who's taking these local people out to coffee, and she's well known in the local area, getting more well known? I think that's the power of focus on some level. So Meg, I've got a couple of slides I wanted to go through, and somehow we've taken up, there's just a flood. We had 54 questions. I know 20 of your questions I wasn't able to get to because they're hyper specific, and we've already partially answered them through other answers. So I'll have Meg give out her website or her email, whatever she's most comfortable with here before I jump back into my PowerPoint. I'm going to have maybe just 10 minutes of PowerPoint slides, and we'll wrap it up for today's webinar, and we'll be back with another webinar next week. But before we give out your contact details, Meg, is there any last points you wanted to make that you just got reminded of through all those questions? Any last mistakes or insights, or did we cover everything that you had planned to share today?
Yeah, I think we mainly covered everything. I think that co-GPs can be really good and just very beneficial and help you scale. Just be really careful. I mean, it's a kind of a trite lesson, but with who you go into business with, I mean, that's just the main thing.
Sure. And what's the best way to get in touch with you and your team? Is it via your website or an email address, or what do you prefer?
Yeah, you can just email my assistant at casouthdevelopment.com. That's my website. So it's just assistant at casouthdevelopment.com. Okay,
great. Thank you. And I hit the mute button on yours now, just to avoid any random noises coming through there. I definitely appreciate you being on the line. I see a lot of people saying thank you for being here. So I think there's a ton of people that will benefit from doing this interview and making it really granular and specific to someone who can share that experience that's kind of going on in real time on your 11 or 12 live projects right now. So thank you for your time. And you can check out our YouTube channel. You can see another member spotlight interview with Meg as well for a little bit more details on CA South there. All right, so we're just going to wrap up with a couple of slides here. I just wanted to give a couple more examples of deals that are being negotiated right now, just to show the size and types of these. One is from an investor who has some debt investors who are looking to the sponsor for a deal flow. The sponsor needs to be in a control position, but they want to go to another GP who's got excellent deal flow, excellent execution, and basically be able to leverage a co-GP relationship. He needs to be in control of that deal or his debt investors to make the deal work. And so he's negotiating, a $10 million term sheet with a GP that he identified through the Family Office Club. I don't know if the deal will get done because the terms need to be exciting for both sides. And that's something I think that everyone needs to navigate kind of fluidly as they find these opportunities. If someone's not used to doing a co-GP deal and they're used to getting the full pie for themselves, you have to find partners that are willing to give part of that up. So it's a win-win for everyone involved. So I'm not sure if the deal will get done or not. I hope so. There's another deal, they're a client of ours through our privateequity.com investor portal. Another client of ours is looking at a $12 million term sheet with a firm that they met at through one of our virtual streamed and live investor events earlier this year. They've taken 4.5, 5 months to negotiate terms, and now they have a letter of intent signed that they'll be hopefully moving forward on. Another one is a $3 million term sheet. And really the only reason why the deal may not go through is because the GP who's allowing another co-GP to come in wants guarantees on how much LP capital they can bring. They don't want it to be a flexible arrangement where they can ratchet up. If they bring this much LP capital, it's this much versus another amount. And to that end, I wanted to address one question that I saw in the Q&A that I didn't want to go into like technical legal speak too much, but there are people out there that will try to get around capital raising laws. They say, oh, I'll just be a co-GP, then you can raise the capital so we can get around broker-dealer capital raising laws. That's not a reason to do it, so I'd be careful about that and always check with your compliance counsel. Like you heard, Meg has counsel on staff, et cetera. Typically, the co-GP is more appropriate when someone's sourcing the deal, adding value to the deal, helping oversee the construction, helping make sure that everything goes well operationally and asset management wise, not just simply not to skip through what otherwise would require you to get licensed. So just be careful on that. $20 million is an amount of another example deal. I was on the phone for 2 hours on Friday afternoon with someone negotiating a $20 million co-GP to the point where my two daughters were kind of invading my video with 10 other people on there because it was time to jump in the pool, and they were done with me being on the video for 2 hours that afternoon. And this was where it's a niche area of investing. There was another Family Office Club member with that niche expertise that's been on a tear on raising capital lately. The first member said, hey, we want to recap our portfolio. And I said, well, let me just think if I know of anyone along my client base. And then I thought of a client that would have that niche expertise. We always teach the 3 trust curves, and this was a group that already knew the industry. They'd be able to due diligence the assets pretty easily. And if this first group can recap their investors, they'll be able to go back out to the market and go and show new properties to those investors and continue to raise capital and grow. So this is a momentum play. It'll also help them get in at better interest rates. So these are 4 examples where all 4 of these are in motion right now among my clients. In addition to that, there are some co-GP investors that we've interviewed within our daily investor mandate interviews. So you can check those out through the membership. If you log in as a member, you can see those mandate interviews and see that some of them talk about wanting to go into co-GP deal structures. A lot of families want to, and they don't know how to find them or source them. So if you're educated on this enough to approach them and negotiate fair terms with them, then it could be a big advantage because other groups might not know how to approach it in a joint venture kind of spirit or sense. So this is part of, when we talk about 150 capital raising strategies by joining the Family Office Club, this is part of the benefit of joining. Dan Sullivan always says there's 2 types of knowledge: specialized knowledge and worthless knowledge. And what we've been talking about here for an hour is specialized knowledge on co-GP partnerships and joint ventures in private equity deals or real estate deals or investing into an operating business and or multiple operating businesses as a joint venture. A couple more comments here on how to leverage our Family Office Club for joint venture deals. I would navigate the blue pages, which is if you join the Family Office Club, you can get a listing in the blue pages. It's like our version of the yellow pages for our members. So you can explore and see who's in there in membership, and people can find you as well. I would look for, asking questions and getting some exposure via the webinars we have, discussion panels we have as either a participant or a sponsor of some type, and just seeing who's on the virtual webinars, who's on the virtual discussion panels, and looking at our 50+ recorded event and webinar recordings and see who's been speaking at those events, who's said on stage they're looking for co-GP deals, they structure co-GP deals all the time, who's sponsored to speak at one of the events, and approaching people that way. You'll also find that all of our 5 capital raising workshops, 5.5 hours long each, talk about different strategies that are related to what Meg said about being focused, about removing friction, not having 9 types of fees, in some cases having it be more performance-based. All those things can help you get momentum strategy-wise and are relevant to structuring joint ventures and co-GP deals. You can also get strategies on negotiating and sourcing deal flow. We talk about that quite a bit within our Private Investor Advantage workshop. So I'd really encourage you to look at that workshop and our webinar on deal flow and deal origination. And then also you can learn what types of investors you should be focusing on and how to attract investors versus closing. That's going to go for attracting co-GP partners as well. So if you're not already registered and you are an investor, not someone raising capital, but you're just looking to deploy capital into passive assets, income investments, or into development deals, et cetera, then go to privateequity.com. This is only if you're an investor, not if you're raising capital or syndicating deals of any type. But if you're just an investor, go to privateequity.com and then we can work together directly. We have 112 investors that we work with in this fashion, and we just launched this last week in January, first week of February. So it's been taking off nicely, and we're looking to grow this to 250 investors this year that we can be showing some of our best of the best deals to through the Family Office Club. If you are looking to do joint ventures, co-GP deals, if you're looking to raise capital, syndicate deals, if you work in investor relations, or if you're the principal of a operating business or an investment firm that wants to strengthen your ability to raise capital and do investor relations, then please go to familyoffices.com and scroll down on the homepage there and fill out the registration form to become a member today. We guarantee you're gonna love it. We've this is basically my life's work the last 13 years, putting as much value as possible into the portal. Just one of our workshops, our capital raising workshops, will probably give you more ideas to give you a 10 times return on your membership. And that's 3% of the content of the portal. So log in there, be part of the community, and you can connect with investors, connect with your peers, connect with my team, and we'll help you improve your pitch deck materials, improve your strategies, give you access to investor leads, et cetera. Here's a little view of what the portal looks like when you log in. So you can see the investor mandate interviews, you can see the discussion panels. There's links to register for webinars live, virtual panels that are live every week, as well as look through our library of past webinars submit your Blue Pages listing and submit your materials for review. Again, my name is Richard Wilson, and I just want to thank you and thank everyone for their time today. See, we have a couple questions here. I'll make sure there's nothing that we should be addressing real quick before we sign off. Looks like some very specific questions that I can follow up with offline here. So thank you again for everyone's time. We are recording this, and the recording and presentation will be sent out in a thank you email tomorrow. And we look forward to seeing you next week on our live webinar next week. And thank you again, Meg, for being here today.
Thanks.
Bye, everyone.